There are advantages as well as disadvantages to paying off a personal loan ahead of schedule. When you pay off a loan faster than it accrues interest, you not only reduce the amount of debt you owe relative to the amount of income you make, but you also save money. However, there are certain lenders that impose a prepayment penalty for early payments, and if you use your spare income to pay off your loan early, then you won't have any money left over for other obligations. If you pay off the entire balance early, you won't have the option to improve your credit score by meeting the monthly minimum payment requirements and making those payments on schedule. If you have come to the conclusion that paying off your debt ahead of schedule is the most advantageous choice, the following are the 5 most important steps you should take. 1. Partially pay for things. You have the option of splitting the payment for your monthly loan into 2 installments that are made every 2 weeks provided that your lender does not impose any prepayment penalties. This is the simplest and most effective strategy for reducing your debt as quickly as possible. You will be able to accelerate the process of paying off your debt because your payments will be broken down in this manner, which will result in one more payment being made each year. By dividing your regular monthly payment into 2 parts and making an additional payment on each one, you will be able to minimize the amount of interest you will have to pay throughout the course of the loan and shorten its overall duration. Take, for instance, if the monthly minimum payment on your loan is $400, you have the option of making payments of $225 each month and contributing an additional $50 each month against the principal balance of your loan. This enables you to stay ahead of the game and pay off your loan sooner, all while maintaining the positive effects on your credit that come with making regular payments. If you get paid every 2 weeks and want to pay off your debt more quickly while still maintaining your current level of financial stability, one viable alternative would be to divide your monthly loan payments into smaller amounts that are paid every 2 weeks. However, before you make any move, you should discuss it with your lender first because certain lenders may have more stringent repayment schedules or may incur prepayment penalties. 2. Make supplemental payments whenever you are able to. You are able to make additional payments toward the reduction of your debt even if you do not have sufficient additional money to make higher payments every month. You can still make additional payments from time to time. Think about using the extra money you get from celebrations such as birthdays, holidays, and bonuses, as well as any other extra savings you get throughout the year. It may be as simple as reducing the number of times per month that you eat out in order to free up some additional funds in your budget for the payment on your loan. This strategy entails making just minor adjustments to your routine in order to create space in your budget for more payments on your loan. It's always a good idea to keep your finances in order and put money away whenever you can, but it's especially important to do so if you want to pay off a debt faster. If, on the other hand, your finances are tight, you do not have to rush to pay off your debt early. Your financial situation will remain stable so long as you continue to meet the required minimum payment on your loan each month. However, if you can make room in your finances for an additional loan payment once in a while, this will help you pay down your loan more quickly and reduce the amount of interest you have to pay. 3. Take into consideration the addition of a secondary source of income. Finding additional sources of income, provided you have the time to do it, could be an effective approach to save money toward the early repayment of your debt. Obtaining a part-time occupation is not synonymous with searching for a second employment. There are numerous opportunities available to earn some additional funds on the side. You may attempt babysitting, pet sitting, tutoring, food and grocery delivery, launching an Etsy shop, driving for Uber, or any one of a myriad of other potential avenues of employment. It is becoming more common for people to say that they make at least half of their income from a part-time job or a side business. 40% of millennials report that this is the case. However, a poll conducted by Bankrate indicated that 41% of people who have a side hustle do so in order to afford the costs of day-to-day life. Only 17% of people who have side hustles put the extra money they make towards savings, and only 12% use the money to get ahead on their bills. If you are thinking about beginning a side business in order to pay off your debts, you should make sure that you first take care of your day-to-day costs and savings before you start worrying about paying off your debt. 4. Look over your financial plan again. Creating and sticking to a monthly budget is an excellent approach to get your financial house in order and identify areas in which you may be able to make some savings. However, it can be challenging to stick to a budget, particularly in light of the persistently high rate of inflation and the fact that many people are struggling to make ends meet. Only 32% of households in the United States really create monthly budgets. Keeping track of your spending patterns and identifying areas in which you could reduce your outlays and increase your savings is made possible when you create and adhere to a monthly budget. A recent survey, for instance, found that 42% of respondents were paying for subscription services that they no longer used, despite the fact that they continued to pay for them. If you want to put more money toward paying off your loans, revising your budget and searching for areas where you may save money could be an excellent approach to achieve this goal. Bankrate provides information that might assist you in getting started with budgeting if you are new to the process. If your circumstance is more complex or if you require more specialist assistance, it may be worthwhile to consult with a financial advisor. 5. Consider your options for refinancing your existing personal loan. Refinancing is yet another method that could potentially reduce the length of time your loan is outstanding for. You can choose to refinance a single loan or obtain a debt consolidation loan to consolidate numerous smaller loans into one larger one. When you refinance, you can move your existing debt onto a new loan that may have more favorable terms, such as a reduced interest rate or a more flexible repayment schedule. You might be able to reduce your monthly payments and get out of debt more quickly by refinancing your loan. However, there are several situations in which it may not make sense to refinance an existing debt. You should only consider refinancing your loan if doing so will allow you to acquire a new loan with a cheaper interest rate or if you require an extension on the length of your repayment period. If you have just seen an improvement in your credit score and believe that you may now be eligible for lower interest rates with the new score, refinancing may be able to assist you in securing those lower rates. You will be able to pay off your loan sooner if you refinance it and get a reduced interest rate as a result. This will result in a reduction in your monthly payment amount. You will also have the option to select a shorter payback period, which will bring the total duration of your loan down to a shorter time frame. Before making a final decision to refinance, you should check out the conditions set by your current lender. This method is probably not worth it if you are towards the end of paying off your loan or if the interest rate on a refinanced loan would be greater than the original interest rate. Pay close attention to any costs that you might be required to pay.